Hi, everyone. Just give us 2 minutes while we wait for people to log in, and we'll get started with the session. Great. So very good evening to everyone, and welcome to today's webinar. It's titled Health and Life Insurance During COVID, All You Wanted to Know, hosted by the CFA Society India. I would like to take a moment to welcome our audience joining us remotely. We hope you're keeping safe, and in good health. I am Ravi Saraugi, a SEBI registered investment advisor, as well as co-founder of Samasthiti Advisors. And I will be your moderator for today's webinar. Now, before I introduce our speaker, I have a couple of housekeeping notes, and I'll make it very quick. So today's webinar is scheduled for 60 minutes with half the time allocated for Q&A. So we have significant time to address your insurance related queries with our expert. So please keep your questions handy, keep them coming. You can submit your questions throughout the presentation, and you can do so by clicking on the Q&A link at the bottom of your viewer, and you can type in the questions in the box. We value your feedback, so please complete the evaluation survey before you sign off today. And you can log into the CFA Society India's website for details on past and the future events. Now it's my pleasure to introduce our speaker for today's webinar, Mahavir Chopra, who is the founder of beshak.org. He really does not need any introduction, and I will not read out his long bio. Anyone familiar with the work Mahavir and his team is doing at Beshak would know that he is the foremost expert for consumer-based insurance products, in India, and has spent a considerable amount of time in his career, in this sector. So I'll request, Mahavir to briefly talk about what they do at Beshak before continuing.
Thank you, Ravi, for the kind introduction. I'm assuming a good number of people would not know me. You made me sound like a kind of celebrity. Just to give a quick background about me, I'm basically a chartered accountant by qualification, and I have basically around 16 years of experience in digital insurance. I started in my stint with insurance around 2005, 2006, and been in insurance distribution for the last 16 years. And my last job was with CoverFox, where I was the chief business officer. I was basically taking care of the entire business at CoverFox. And now, for the last 1 year, I've been building something which is called beshak.org. Beshak.org is basically a platform that is a venture which wants to provide neutral, conflict-free advice to individual customers looking for the right kind of information to make well-informed decisions in insurance. Now, while I was in distribution, I realized that while there are so many people who are wanting to sell insurance, there is a dearth of right information available to make decisions right through. Meaning, everybody is focusing on selling, everybody is focusing on advising, if I could say that, but there was a dearth of the right kind of information, and whether there were the right kind of experts available and curated so that people could take decisions. Insurance has been a space where there is a lot of trust issues, and because of obviously the kind of things that we hear about insurance, there has always been a kind of bad reputation about insurance, that insurance mein claim nahi milta hai, insurance ka ye issue, that issue. We want to basically change that. We feel that there are good people in insurance, both on the supply side as well as on the buying side. Not all customers are frauds, not all advisors, not all sellers are bad. How do we curate the right community and bring the right kind of people together so that everybody wins, and largely people who are looking at financial security in their life get the best financial security for the money that they pay. That's the goal behind Beshak.org.
Thanks, Mahavir. In fact, it's really much needed, and I would strongly encourage everyone here to check out Beshak.org. They have a brilliant community where you can post questions. They have really good booklets, which very shortly and crisply and in a do-it-yourself fashion really tries to explain to you how you can demystify insurance and get yourself covered. It's a lot of fantastic stuff. So do check out the community. So now with that, so let's get on with the show. And what we'll do is we'll first discuss life insurance, because I think it's a lot easier to tackle, than health insurance, which always looks, feels and looks like a monster. So we'll keep our discussion, between me and Mahavir limited to about 30 minutes or less, leaving the balance time, for addressing, your questions. So coming to life insurance, Mahavir, very quickly, out of the different products, which are available for life insurance, why is term life insurance the best way, to get insured?
Right. So if you're looking at life insurance specifically, the reason why you're looking for it, I'm assuming this is that you're looking for financial security, and there isn't any other product as good or as effective in terms of the cost and the kind of output you can get out of that cost other than term life insurance. I think apart from term life insurance, all the products that life insurance sell are products that compete with mutual funds or with fixed deposits, and those are products where very clear. If you're very clear about why you want to buy those products and you know all the terms and conditions of those products, only you should be touching those products. Apart from that, for a regular user, term life insurance for someone who has financial dependence and basically is someone who wants to cover them with a financial security, I think term insurance is the kind of a norm. I think you can't do without a term insurance, and I think most of the people here would agree with that. So that would be my answer, Ravi.
So Mahavir, just on very average and ballpark number, the annual premium which you pay on your term life cover, what's
Right.
on average the premium X that the coverage that you can pay?
So you usually get close to around 800 to 1000 times the premium that you pay as a cover if you take an annual premium option. So typically, let's say if you pay close, let's say if you're 25, between 25 and 30 year old, then you will actually pay like 10,000 rupees and you can get a cover of 1 crore. So that's the kind of cover you can get at a very small sum of money, right? So it basically is a pure risk cover. It does not offer any kind of return of premium or any kind of return of investment. It's simply paying 10,000 rupees for a certain term, and in that term, if you basically pass away, then your family basically gets that entire the corpus that you have basically figured out for them, which is like could be the sum insured, which is like 1 crore, 1.5 crore, 2 crore, whatever you've decided that way. So term insurance that way gives you, for a very small sum of money, gives you a very large cover. That's, I think, the biggest highlight of term insurance. Yeah.
So should everyone get term life cover?
Not really, actually. There are two kinds of people who don't need term insurance largely. One is a person who does not have financial dependence or does not foresee having financial dependence in the future. And second, someone who is financially free already, like someone who already has enough cash or enough wealth which can take care of their family's needs, irrespective of whether he's living or he passes away, he's not around. Someone with enough passive income, someone with, those kind of people don't need term insurance. And like I said, people who don't have financial dependence or don't foresee financial dependence, let's say in the next 5 years, they also don't need term life insurance.
So for so let's take an example where, say, if you currently do not have any dependents, maybe you're very young, should you still buy term life cover to lock in a lower premium, or should you wait, till you have dependents?
Right. So yeah, this is a question that keeps coming, and the answer to this is that usually the advice is that, meaning which we give, and we've written a elaborate book on this, and and you can check it out on our website. It's free for download. Is that you shouldn't buy anything that you don't need, right? Meaning that's like the primary principle of financial living a financial life. So when you don't need a product, according to us, you should not buy. That is the first part of the answer. The second part of the answer is, even if you do a math, like for example, if someone at 25 buys a 1 crore cover, let's say it will cost him 8,000 rupees. The same guy buys term insurance at, let's say, the age of 30, it will cost him, let's say, 10,000 rupees. The 2,000 rupees is that he will save from year 25 to, let's say, if he takes a policy till 65 years of age. So 40 years premium is what he will save. And that is what he'll save 2,000 rupees for 40 years, right? Is the math that people do. But look at it from another point of view, that if you start your cover at 30, you will not be paying that 2 years of 2,000 rupees additional premium for those number of years. Not be paying the entire 8,000 rupees for the first 5 years, right? So when you're not paying that 8,000 rupees for the first 5 years, and let's say, meaning people here calculations of investments and all that much better than me. So agar aap 8,000 rupees, if you invest that for the first 5 years into some kind of, very, very average kind of, let's say 8% per annum return also, and then you calculate what you're going to pay after 30, it will more or less break even. So answer one, by sheer not needing insurance, you should not buy. Answer two, even by math, you don't need to buy. Even if you do like math of the entire net present value of the premium that you're going to pay, and do all kinds of calculation, you will end up saving not more than 5 to 10% on the aggregate premium that you pay across your life. And we've done these calculations. So if you go to that ebook that I'm talking about, we've actually put calculations and explained how it doesn't make a very big difference. So it is over calculating and trying to over optimize for something as simple as term life insurance. I think keep it simple. Once you have financial independence, buy term insurance.
Great. So Mahavir, in fact, in this ebook that you were referring, you have very nicely explained how, in a detailed way, you can estimate what is the amount of term life, that you should get. And I don't think there's a point of going through what you have covered in that ebook here.
Right.
But let's say, somebody, just wants, a brief rule of thumb to just make his life easy. Now, what would you say is a safe, way to estimate what's the amount of term life cover that you need?
Right. So the first thing is that there is some kind of, thumb rule that insurance sellers will offer you, which is basically telling you that buy 20x of your income, 25x of that income. That purely comes from a logic of what is the eligibility that insurers have defined for you. And it doesn't really solve for your problems. You may actually need more, or you may actually need less. And that is based on your financial life and what are your financial needs and your family's financial needs. So largely, if I have to keep it in a very nutshell, meaning if I have to answer this question, how we have, and this is actually the first time that someone has given this kind of a calculation, at least in India, is that how you should calculate your term insurance cover is look at the financial gap that you have in your family, is financial security. And how do you calculate that is by understanding what are going to be their today and their future financial needs, in terms of what is the kind of corpus they will need. Let's say first is the assumption that, let's say if I'm going to pass away today, what is the kind of corpus that my family will need to be able to, let's say, earn from that corpus's passive income and live a disruption free life. That is the first thing. Second is that, are there any kind of financial loans that I've taken which I need to repay? Add all the kind of large financial expenses or goals that your family has, right? Meaning, let's say if you have children, then your children's education, children's marriage, If your wife wants to do further education, then the cost of that, add all those things on one side and subtract it with what you have today, right? So what you owe minus what you own is the calculation that you should do. Find out the financial gap, and that's where you need term insurance, right? Inflation would be another part that would basically come into picture, because I'm talking about someone like assuming that he passes away today. For calculating or factoring inflation into this cover calculation, you can buy an increasing cover. By buying an increasing cover, you can take care of inflation. There are almost all leading insurance companies today offer an increasing cover option, which is close to like 5% to 10% increase year on year on your term insurance cover. That way. So inflation is taken care of, your financial gap is taken care of. That is how you should calculate term insurance coverage.
Great. So yeah, so in fact, that brings me to the next question. You mentioned increasing cover,
Right.
and I'd really like to cover with you briefly, because there's so
Yes.
many riders. So term life, it looks like a very simple product.
Yeah.
And then you log in and then you start buying it.
Crazy.
And then the screen shows you this long list of riders. So what I thought was, for the benefit of the audience,
Right.
I'll run through the list of riders.
Sure.
And if you could tell me briefly, this is outright reject, this is definitely must have, and the third category that you must evaluate based on your personal circumstances.
Makes
So
sense.
let me run this.
Sure.
Critical illness cover.
Very, very important. You should look at it, meaning you should consider it. Obviously, understand the kind of coverage that you need, but it is very, very important. If you look at critical illness as a policy, and I'll take a minute because this is very, very important topic.
Sure, please go ahead.
Critical illness premiums are higher than term insurance premiums. I tweeted about this about a week back. Critical illness premiums per lakh at a same age, meaning let's say I'm 30 years old and I'm looking at buying critical illness, per lakh premium is higher than the premium per lakh for term insurance. And the question that should come to your mind is, why is that? Because insurers know something that we should also know, is that there is a higher chance. Why are premiums higher for anything? The premiums are higher because there are higher chances of you getting or suffering from a critical illness than having an early death. Right? The way the medical science is advancing, there are much more chances of all of us, God forbid it should never happen, but all of us suffering from a critical illness and having a dent on our incomes, having to pay for regular medical costs which are not covered under health insurance, and also having to change our lifestyle. All this can cost a bomb, right? From that particular reason, and the chances of a critical illness being higher than actually an early death, critical illness is a very, very important cover that you should buy. In fact, because we feel so strongly about this, we made a separate ebook only for critical illness also, which is also available on the website, meaning for people who want to, explore further into what I just spoke about, please go through that ebook if you get a chance.
So, and just an add-on question on that, critical illness cover is recommended as part of your term life cover, or should you take it as part of your health insurance?
Yeah. So as a rider, both, if it is available from a health insurance company or is it available with your life insurance company, that doesn't matter. You could take it from either of the two. There are much more chances that the rider that is available with a life insurance company will have more stable premiums, because life insurance companies are more are more competent to be able to calculate long-term premiums for a customer. Most of the health insurance companies change premiums every year or every 2-3 years. So from a stability point of view, from a point of view of having fixed premiums all your life, and you don't have to worry about premiums getting increased in the future, buying it with your term life insurance policy is a better bet. There are standalone critical illness policies also available, but they are very, very expensive, and the premiums escalate very fast after you cross 50, which is when you may need a critical illness cover. And hence, from a purely cost benefit point of view, it looks like buying a rider with a term in life insurance is a better option, looking at the cost benefit and all the the problems that we are like trying to solve. As a package, buying it with term life insurance is the best bet.
Perfect. The limited pay rider.
Limited pay rider is purely based on your preference. It is something that there are people who don't want to, like I'm buying a home If I'm buying a home and I'm taking a home loan, there are people who want to prepay that home loan, and certain people who want to enjoy that low interest rate, right? There are different kinds of people. So it's purely based on your personality. If you like to complete your liabilities faster, if you're that kind of a person, then go for limited pay. If you are okay with, and you have a stable income, and you know that you can pay these premiums for a longer period of time, then go for a regular pay. It does not matter. There are multiple options available. It is something that you should pick based on A, your income, and B, your preferences, which is based on how you are basically taking decisions on other, such similar kind of products, like meaning when you're, let's say, like I gave the example of prepaying a home loan. If you're likely to prepay a home loan, I think then it's likely that you would also want to quickly pay your term insurance premiums, and hence limited pay could be useful for you.
Okay, accidental disability rider.
Accidental disability rider is not such a great rider. Accidental disability is a very, very important cover that you should buy. Specifically, living in a country like India, we don't have great safety standards, meaning, and also life is unpredictable. There are only three major risks that can actually disrupt your family's financial life. One is death, the other is disease, and third is disability. Disability should be covered, and one of the primary reasons why you should cover it is that it is also, one is that it is very crucial for your family, but B, it is also available at a very low cost, right, at present today. So whether you should buy a rider versus whether you should buy a standalone, you should buy a standalone because that's much more comprehensive. But if you're likely to forget, if you're likely to, you're not that kind of a disciplined person on the financial side, and you want to, just complete a task, then it's fine to buy even a rider. If you really want to give a good cover to your family, then you should buy a standalone disability with disability policy, and there are really, really good disability policies available in the market.
Perfect. So the increasing cover option you spoke about, and yes, you should opt for that.
Right.
And what about the waiver of premium rider?
Yeah, waiver of premium riders are super cheap. So I usually recommend them as no-brainers because they cost you like 100-200 rupees a year. They basically offer you, in case of a critical illness or a disability, all your future premiums get waived off. So from a cost benefit point of view, they turn out to be very cheap. So usually we recommend them.
Okay.
Yeah.
Great. So I think we'll have one last question under the life insurance part before we move to the health insurance section. And that is, could you clarify, taking term life under the Married Women's Property Act versus not opting for it?
Right. Yeah. So this is another interesting thing that we've brought in our ebook is the Married Women's Property Act. Basically, when you buy a policy under a Married Women's Property Act, you are in a way, transferring the entire entitlement of the cover that is available, meaning the outcome that of the policy. Let's say there's a claim to your wife. So if you're a married man, and you want to basically make your wife the nominee, buying it under Married Women's Property Act gives an additional layer of security to your wife. And how does that happen? Is that two things happen when you buy it under Married Women's Property Act. The wife basically has full control of the money that is received. Nobody can basically lay any claim on that money. Neither creditors, neither any family members through the succession laws cannot make any claim on that money, right? So from that point of view, it is a great additional security. At any point in time, your wife will get the money, and you have extra assurance over and above the nomination formalities that you've done with the insurance company, and this is by law. Obviously there's a negative to this. The negative to this is very simple, is that at any point in time you will not be able to reverse this. Once you buy a policy under Married Women's Property Act, there is no way you can reverse it or cancel Married Women's Property. Buying a policy under Married Women's Property Act, it's gone, right? So there is no way to reverse it. So if you're taking a decision, be very cognizant about this fact before taking the decision. Most of us, meaning I bought a policy, I've taken it under Married Women's Property Act because I feel it makes life very simple for my wife, and she doesn't have to worry about claims coming from family members or any creditors that I have taken loans from. She can then decide whether she wants to repay the loan or not repay the loan that way.
Okay, perfect. Good. So I think we'll wrap up the life insurance section and we'll quickly move to the health insurance part. So Mahavir, this is of course a time when people are really taking stock of how insured they are, whether they are insured at all, and if they do have insurance, whether it's adequate or not. So on the health insurance front, is there some quick steps that someone can take to make sure in the background of the pandemic, to make sure that at least they are protected against any ill effects of the COVID pandemic?
Right. So standard health insurance, obviously everybody should have. Actually, the pandemic is a very important event that people have realized that we are not invincible. It's given us, while obviously there has been a lot of pain and we've everybody suffered a lot. You've also got a lot of learnings out of it, and there are two major learnings. One is that even the healthiest of the person can need a health insurance, and second is that the coverage that you own today, and people felt that 3 lakhs cover was good enough, 4 lakhs cover was good enough. Even today there are people who have multiple hospitalizations in their family. Have seen even higher coverage is not being good enough for them, right? Meaning when you have 2-3 hospitalizations, each having a hospital bill of let's say 3 lakhs each, your total bill could be like 9 lakhs or something like that, and you could actually suffer with a lower cover and pay out of your pocket. So from a point of view of having adequate sum insured, we first thing is that you should look at adequately covering your family. We usually recommend looking at today's, let's say if you're a 35-year-old, we recommend a cover of minimum 10 to 15 lakhs per adult. The reason is that if you look at the average hospital bill today is around 2.5 lakhs. Put an inflation on that for let's say around 20 years from today, you're buying a health insurance for your lifetime. Don't forget that you will need it at a time when you are old, but you may not be able to buy that high cover that you need at that time, because if God forbid there is any kind of illness, you will not be able to upgrade your policy. Look at our forum. If you go to our forum and you check, there are thousands of people who have come and said that I have a specific disease and I'm not getting a policy. Insurers are super fussy about people having disease. So buying a cover, a very good, high quality, adequate cover at the time when you don't need it, when you are healthy, young, fit, is the biggest hack you can do, right? Meaning buy the policy when you're super young, and you'll get the bestest deals. You will also be able to compare amongst maximum number of insurers with maximum number of plans. So you have among this humongous number of choices with the best deals available in the market. So ensure that you buy quickly. Don't wait till you turn old to buy health insurance. Don't depend on your company's health insurance also. That's the first thing. Adequate cover is very important. Third is ensure that there are no financial limitations in the policy. If you're buying this policy at a young age, ensure that there are no room rent limits. There are no other kind of financial limits, like there are certain insurers who put limits for certain treatments in the policy. Ensure that those kind of limitations are not there, because they can curtail the kind of cover that you will actually be able to enjoy when there is a claim. So ensure you don't have that. Last is understand the exclusions well. There are multiple exclusions that are there in a health insurance policy. Understand those exclusions well. These are 4 broad things that I would recommend that you should look at. Then there are obviously multiple things, like we've counted last when we are building something on the health insurance side. There are more than 70 benefits in health insurance. So don't look at all the other benefits. The 4 benefits that I mentioned to you, first focus on those 4, and then you could look at everything else as bells and whistles.
So Beshak has a ranking of different health insurance.
We have for term insurance, we are building something for health insurance, which may not be rankings, because health insurance is a very different product. You could do something very different for health insurance. It could be even much more refined than what you have done for term insurance.
Any expected time that will be out?
That should be out by let's say mid of July.
Okay.
It's a very comprehensive solution that we are building. So it's taking a lot of a time to build.
Good, great. So heads up to everyone to keep a lookout for that one. Mahavir, before we go to the Q&A, I just have a
Right.
few questions which I thought would be very useful, because these are questions that people really struggle with when they're buying
Right.
a health insurance. And would you recommend an individual cover or a floater cover?
Right. So this has a very simple answer. What is the first question you should ask yourself is what is the individual cover that you're looking for? If the individual cover that you're looking for is 5 lakhs and you have two adults in the family, buy a 10 lakh floater. The advantage of buying a floater is that you have the aggregate cover that you were looking for on an individual level also, and as a floater also. So if there is a large hospitalization that one family member has, he can pool into your cover because it's a floater. At the same time, individually, you have enough cover. So typically, earlier, what used to happen is that people used to buy, let's say, individual cover of, let's say, 5 lakhs each. But when they buy, let's say, for a family of four, they used to buy, let's say, let's say 10 lakhs floater, because that is good enough is what I would recommend is that if you have three adults in your family, then you should buy if you're looking at buying a 5 lakhs individual cover, then aggregate all those and add it up and buy a floater cover. That then gives you advantage of both individual as well as floater.
Okay, great. And I think when people are trying to make sense of which health insurance to get,
Right.
it gets so complex that I think people eventually boil down to just looking at one ratio, which is, I think, the most well understood or most popular, which is claim settlement ratio.
Yeah.
Can you tell us the positives and the negatives of letting that play an important role in deciding which insurance plan you
Yeah.
take?
So for a consumer, actually, this is something that insurers are trying to create as a kind of a number so that customers get confidence. It holds no value for a customer actually. A claim settlement ratio holds in term insurance or in health insurance. It holds no value because it basically tells you that how many number of claims, not amount, number of claims came to an insurer and how many claims got settled. Now, whenever you're looking at a number like that, you will also have to understand that if there is a difference between the number of claims that an insurer received and it settled, the difference should be homogeneous compared to insurer A versus insurer B versus insurer C. And insurer A could be efficient and be rejecting fraudulent claims. And insurer A could be very, very diligent and actually making the deductions that are important for it to be financially viable for all its life, right? So if an insurer is making those deductions or insurer is rejecting a claim because it is fraudulent, it does not make it a bad insurer. According to me, it makes it a good insurer because that company is chances of lasting for a longer period of time and remaining viable is much higher. It does not give you any insights into what you are actually looking for. What you are really looking for when you're looking at claim settlement ratio is whether this insurer will pay my claim and whether I will have a good experience or my family will have a good experience. It does not give you that because it does not tell you whether your claims are settled on time, whether the claims are settled faster by one insurer versus another insurer, whether there are lesser complaints or whether there are issues with respect to, let's say, an insurer rejecting valid claims which are supposed to be paid, how many cases went into consumer court. You don't get all that information, right? That's the reason what Ravi just mentioned is the product that we've created. It is called Beshak Star Rating. If you go to that product, we are basically doing a very, very detailed analysis of all the things that I mentioned, which is basically how fast a claim is settled by an insurer, how many complaints that an insurer A get versus an insurer B, whether an insurer is responsive enough on toll free or not, whether an insurer is fast in responding to your tweets or your complaints that you make on Twitter or not, and almost 100 such parameters is what we have basically done our own research and testing and built an analysis platform that is free for everybody to basically access and analyze, whether they should buy insurer A versus insurer B. So long story short, claim settlement ratio does not give you any insight whether an insurer A is versus insurer B. Beshak Star Rating is an attempt towards giving you what you're really looking at emotionally and mathematically in terms of understanding an insurer and how efficient it is in terms of customer service and claims management. So if for term insurance we built that, for health insurance there is still some time. But that's what we would recommend. Obviously, it's a product that we've built, so we will obviously recommend it. But definitely, it's better than claim settlement ratio. Claim settlement ratio has no value.
Yes, I think that's a very important point for us to, I think any health insurance plan that you do research on, first thing you look at is claim settlement ratio.
Yeah.
That's a great insight. And I think, also another great insight, Mahavir, I really love that, was that you need to get health insurance when you need it the least. I think, people look at it the opposite way.
Right.
So I think we'll wrap up our discussion here. I can see in the Q&A box that we have a healthy list of questions populating there. Please keep them coming. We have about 25, 30 odd minutes. And what I'll do is, I'll pick up questions from here. Mahavir, you also have access to the Q&A, box in case there's something which, you really want to address. Please go ahead. Otherwise, so I'll take the first one. This is from an anonymous attendee. So health insurance premiums, they increase. At least media reports that they have significantly increased during COVID. What can an insured person do? And are there in fact IRDA guidelines, to protect the insured from such rampant increases in premiums?
Yeah. So actually, there are two sides of the story. One side of the story, obviously, is the story that we're talking about right now, is that health insurance premiums have increased. But look at it. I just want to give you a quick insight on the insurer side or the supplier side, how they are basically grappling with multiple problems. And one of the biggest problems that insurers face today is that healthcare is not regulated in the country from a billing perspective. Because healthcare is not regulated, hospitals are able to charge as much as they want to charge, right? Specifically for people who have insurance, you would have all experienced, and I'm assuming most of you would have experienced a claim. If you have, then you would know that hospitals do charge differentially for customers who have insurance versus don't have insurance. So insurers are actually on the receiving end as much as we are on the receiving end in terms of how hospitals are billing, and there is no insight or there's no direction in which we are seeing that government is going to even regulate this cost, let's say in the future. Like in the COVID last wave, meaning the first wave that we had, we saw all kinds of insane hospital bills coming on WhatsApp, people being charged 21 lakhs, 15 lakhs, and insurers, hospitals also charging deposits from insurers. Insurers don't have a lot of say with what the hospitals charge. Even IRDA does not have any say with what hospitals do or how they follow, what kind of protocols they follow, how they will deal with patients and all that. So from that point of view, one side of the story is, yes, you are right, the premiums are increasing, but insurers are also on the receiving end because they are not able to control the cost. Now, what can you do is basically, one is obviously, even if the premiums are increasing, stay invested, stay on the parallelly. What we have suggested, and this is something that we're talking about very actively, is that do create a healthcare fund. Have your own corpus created for the long run. This will help you in two ways. In case health insurance premiums do not stop growing, increasing, right? At a certain point in time, it may become unsustainable for us to pay premiums. So you have a healthcare corpus to back, right? And to basically take care of your healthcare needs. The other thing is that there is a good understanding that we may live longer than people who have lived before us, and there are going to be a lot of other medical expenditure that is not covered under health insurance, which is the routine healthcare expenditure. Like today, I was speaking to my father-in-law about 3 days back. He's spending 1.5 lakh rupees between him and his wife in a year today on regular routine medical expenditure, which is not covered under health insurance, not hospitalization. Look at that and look at now, 20 years from now, if you inflate that money, what is the kind of living expenditure, additional living expenditure you are going to need to be able to take care of healthcare expenses so that you live a very, very good quality life. So from that point of view, two things. One is stay invested in health insurance, be aware of the premiums that are increasing, keep an understanding of how premiums are increasing, also keep evaluating whether it's sustainable for you or not. Secondly, keep building a healthcare corpus for yourself in case things don't improve or healthcare does not get regulated or insurers don't find a better way to control costs. then you will have to depend on this corpus. That is my view of the entire the trends that we are seeing.
Okay, so next, another anonymous question, but an interesting one. So it says, if I bought term life insurance before marriage and my parents are nominee, what is the law? Who will get the claim?
No, sorry, I missed your question. Can you repeat the question?
So someone bought a term life insurance and they had their parents as the nominee.
Right.
And now the person is married.
Hmm.
So who has the claim to the insurance money?
Yeah, so this is slightly complicated. There is something in the Insurance Act which is called beneficiary nominee. Beneficiary nominee is a certain list of family members who, if they are made a nominee, then they will be called beneficiary nominees, and they will be entitled to the final money that is received by the because of the claim that has come in or because of the death of this person. So from that point of view, it makes it very clear that insurers will pay the money to the nominee that is there in the policy. In this case, what you mentioned, the parent will get the money from the insurer. There have been a lot of otherwise, but outside insurance and insurance laws, there have been obviously a lot of disputes and cases that have happened where succession laws come into picture. I'm not an expert in succession laws, from that perspective, because there could be a lot of disputes that could come in. Either when you get married, you can change your nominees as many number of times as you want. You can add your additional family members like your child or your wife into the nomination. Also change the proportion of share that you want to give each other as you like. That is one. Second is that if you want to only make your wife a nominee and withdraw from making your parents the nominee because maybe they are taking care of their life, then that is also something that you can do. You could also take MWP. You can't change your policy into MWP after you bought it. So that you can't do. The other thing that we usually recommend is that ensure that you take some time out and make a will, right? And this sounds very rich man like thing, or it sounds like you are very old, but people today, there's a good trend that people in their 40s have started making their wills purely from a point of view of keeping their family's life very simple after they pass away, that they are clearly allocating money to whoever they want to allocate while they are alive. So the best thing to do would be, and the idealist way to manage this is to have a will. The other way is to ensure that you are clear about the nominee and the proportion that you want to give and ensure that you've corrected them, the nominee proportions whenever you want to, right? Meaning you could correct them, you could change them as many number of times you want to. You just have to go online. Most of the insurers have this facility online. You just have to log into their website and you can change nomination over internet. So you don't have to even go and walk into an office. So these are the two things that we recommend. Nominee, keep reviewing your nominee list. Second is will.
Perfect. Very interesting question from Nilesh Makwana. So we discussed, in the webinar that under the Married Women Property Act, the husband can ensure that the wife gets the proceeds. Yeah. This question reads, what are the options for a woman buying a term insurance and protecting the claim against creditors?
No, so there is no married husbands act available. So you won't be able to do anything about that. Usually any payout that comes from any claim, obviously creditors would have a claim over that, because that is how the law in the country works. So there is nothing that is available.
So can the woman make a will? And
I think from what I understand, and I'm not an expert on this, but from what I understand is that even if there is a will, but if the person who has passed away had loans, still, and the lender would have a claim over the money, is what I understand. I don't think, like, if I have taken a very large loan, I can make a will where I say that don't give money to my lender, and that will work in the country. Otherwise, it will become a very weird thing for lenders, right? Meaning won't work. Yeah.
Okay, so another anonymous question. So you had mentioned, this question reads, you had mentioned it is better to go for a critical illness rider with a life insurer And the question is, do they provide extensive coverage similar to health policy? Whatever critical illness rider you're taking, say, on your health policy.
Right.
Would it be comparable?
Yeah, so a standalone critical illness policy will give you much more wider cover, but the only difference that I have seen is the premiums are significantly different, and the standalone premiums for critical illness, meaning the premiums for standalone critical illness policies, they increase every year, or every, like they increase in health insurance every 5 years as your age band goes up. And what we have seen is that as you hit 50, 55, the premiums are very, very high, right? And hence, our study says, and this is something we have covered in our critical illness ebook, is that if you look at this entire thing as a package in terms of how premiums grow in a standalone cover versus riders which have stable premiums but a restricted cover over critical illness, we feel that a rider with restricted cover is more sustainable because the premiums are more sensible there compared to what is the case with standalone policies. And hence, we recommend buying a rider versus a standalone policy.
Perfect. I think, Mahavir, this is a very important question from Shailesh Gupta.
Right.
Why do you feel that we should not rely on health insurance policy provided by the employer?
So it's actually a very good question. Thank you for asking this, Shailesh. There are three primary reasons why you should always have your own policy. One is that the health insurance policy that is bought by an employer, and I have in my life sold a lot of group health insurance policies, and I can tell you this: the person who is negotiating for group health insurance for their employees with an insurer, their main goal is not your healthcare, but ensuring that there is a tick in the box most of the times that there is health insurance given to employees. And on the other hand, they have another goal, which is basically to ensure that the budgets are in control, right? So at any point in time, if they see that the costs or the premiums on health insurance are growing very, have increased or escalated a lot, there is a chance that they could curb the policy, they could curb the benefits. And I've seen this happening multiple times in my career, that large corporates have curbed the policy, put a copay, added certain conditions, having seen that the premiums have increased a lot. So my first question to you is that, are you okay with your healthcare needs being controlled, or where you go to, which hospital you go to, what kind of out-of-pocket expenses you pay? Are you okay with that being controlled by the CFO of your organization or the head of HR of your organization? That's the first question. The second question is that, are you not making an assumption that you will always work with an organization which will have health insurance? There are a lot of startups, there are a lot of companies that don't provide health insurance or don't provide adequate health insurance. Third is basically you could be between jobs, right? If you're between two jobs and you're without a cover, it does not really, you could have to pay a lot of money from your pocket. And remember, the most important point is that while you are covered under corporate, you are healthy, fine, everything. As soon as you don't have health insurance, let's say you're getting retired, it's going to become very difficult for you to get health insurance from two counts. One is that, let's say if you have a disease, or even if you don't have a disease, but you've crossed, let's say 50, 55, it becomes very tricky for you to get the best health insurance deals in the market. Second, premiums could be loaded because of, let's say, you or any of your family members having a disease. So from any point of view, all the dimensions that I spoke about, not having your own policy, let's say by the time you hit 28 to 30, is a no-brainer. You should always start, even if you want to start small, start with a cover of 5 lakhs floater and gradually grow it, but ensure that you have your own policy. Don't depend on a policy that is not controlled by you.
Perfect. Thanks a lot, Mahavir, for, I'm sure that would have clarified for a lot of people, who feel complacent about the fact that because their employers, are providing, so maybe they don't need a separate cover. Right. So Mahavir, this is another interesting question. I know it will be difficult for you to go into product specific discussions, but this is, more at a general level. This is by Darshan Nakhate, who says, should one go with private health insurer or government PSU insurers? Now, of course, I understand maybe there is no general good or bad, but
Right.
maybe there could be factors that if XYZ is important to you, you should go with public insurer, or if XYZ is more
Yeah.
important to you, should. Are there any such kind of stuff which can help people decide?
Yeah. So first, very primary thing is that whatever I mentioned in the beginning, that should be very clear, that you ensure that you have adequate coverage, you've covered all your family members, you don't have financial limitations in your policy, you've understood all the exclusions, all that fundamentals you are clear about. First is that is the primary thing. Then comes all these things like private versus government. Between private and government, there is one thing that I would like to mention, more or less. There isn't a very big difference, but the largest difference that I have seen in my career is that uh, private works on a very centralized model where all their decisions and all their processes happen at a central level. Government insurers work at a very decentralized model where everything happens at branch offices. Now, from your own experience, you would know that there are positives or dealing with a company which has everything centralized, because then everything is standard, everything is standardized. But there are negatives also, because then the system is very cold, right? Because there is no personal element to decisions that are taken. All decisions are taken by processing people who are sitting, let's say, in one office in one corner of the country, versus a government player which is decentralized, where you are actually, maybe also the you or the agent has a personal relationship with that branch manager who's actually issuing the policy to you. So there is some kind of empathy that is what I have seen in my career when dealing with private versus government. That is one point. But there is a negative of decentralization also. There's a lot of inefficiency that comes in, because everything that follows something where there is duplication of effort versus multiple branches doing something, or there are external companies doing it. Like most of the government insurance companies have external third party TPAs who process their claims. There will be a tinge of inefficiency that you will see, and there could be additional follow-ups, or some kind of bureaucracy that will seep in. So bureaucracy is one negative for government insurance companies. The positive is personalization, kind of a rapport, and some kind of empathy that is there. On the private side, you will see very, very hardcore, serious processes which help in efficiency. But the negative is that then there is no looking back. You may have a very, very humanitarian reason of accepting, and someone should accept your claim, but the system will reject a claim in a private sector. So you need to take a call between these things that I've mentioned.
Next question, Yogendra Joshi. Can one split between base health cover and super top up?
Yes. So very compelling reasons for why you should break up between a super top up and a base policy, because the premiums that you will get, like if you're buying a 25 lakh cover as a single policy versus buying.
So maybe Mahavir, you could first clarify what a super top up is. Maybe a lot of people may not be aware.
So super top up is a policy which is like an extension to your main policy, which you can buy from the same insurer or buy from any other insurer. Which what it does is that, let's say you have a 5 lakhs policy and you now want to upgrade, where there are two options. One is that you go to the existing insurer and tell them that, hey, I want to now upgrade this cover to 10 lakhs. And the same policy is upgraded with a cover of additional 5 lakhs. That is one option. The other option is the super top up option, where you get a separate policy which sits on this policy. So it is like 5 lakhs plus 5 lakhs, and it's like an extension. It is not a part of your main policy. It could have its own terms and conditions. So, so that is super top up. It's an extension to your base policy. The reason why people do opt for a base plus super top up versus buying a large cover is largely the price. You can save significant amount of money by buying a policy which is a combo between a base and a super top up policy, instead of buying one large cover. There are benefits and negatives of having a combo versus buying one big policy. One big policy could give you larger, better eligibility to cover, because it could basically give you access to much better healthcare in terms of the kind of rooms you can choose and all that. But the premiums would be significantly high. Whenever you buy a policy, you should always compare between these two options, and you will see a compelling reason why you should take a combo of base and super top up. Almost like a 30-40% savings in premium is what you will clearly see. What you should not do when you should buy a super top up is that ensure that you have an enough good base cover so that not all your claims go into two insurance companies and have to be claimed from two insurance companies. So the base policy usually should at least be a 10 lakh floater, right? And then buy whatever extensions you want to buy over that. Don't buy extensions over, let's say, a 3 lakh cover or a 5 lakh cover. That's one. Second is try to see if you can buy from the same insurer. Third is try to see if you can buy the super top up in the same month when you buy when your renewal for your base policies due. These are the three things that we usually recommend people who are looking at base versus super top up, upgrading base versus buying base versus super top.
Okay, great. So Mahavir, so essentially because a base and a super top up is cheaper than a whole base, would it be right to say that the coverage in a base and super top up is inferior to?
No, not really. The cover
so how is there a price arbitrage?
Yeah, so the price arbitrage is because the insurer B, you have to look at it every insurer looks at risk from two point of view, right? And everybody looks at it that way, is that there is a severity and a frequency angle to every risk and how it is calculated. Most of the claims today would come for an average claim is around 1.5 lakhs to 3 lakhs, right? So when an insurer who's giving you a policy of super top up of an extension above 5 lakhs, the chances of having claims in the next 10 years is quite low, right? So this insurer basically, when it's calculating the cover for super top up, is clearly looking at, let's say, 10 years of run without having almost no claims, right? Vis-a-vis an insurer, when it calculates a cover for a policy which is an extension, there is a step up premium that keeps increasing based on the cover that you take. So when I buy a 5 lakh cover, it will cost me 10,000. If I buy a 10 lakh cover, it can't cost me 12,000. It will cost me 15,000, right? So it keeps increasing. So the arbitrage comes from the second insurer in case of super top up, looking at the frequency of claims and the severity of claims coming later part of the years that you will survive, not in the early parts of the years. And hence there is a significant amount of lesser number of claims that the second insurer will get that way.
Okay. Okay, great. So a question from an anonymous attendee: are the accident insurance covers that come free with credit debit cards of banks any good? Do they work?
Yeah, so you need to read them very well because there could be multiple conditions. One of the conditions is that many of these policies could actually cover you only for air accident. So be very careful about that. Read the top. Even if you read the highlights well, you will be able to. They give you a manual, right? Even if you read like the first 10, 15 lines, you will be able to understand that whether it's a full accident cover or a air accident cover. That's one. Second is that it also links the cover to you being an active, user of the card. And let's say if you're not using the card for the last 6 months, that cover could actually not be there or can actually expire or lapse till you again start becoming an active user of the card. So look at it as a bonus and ensure that your family is aware of this so that in case of any unfortunate claim they can use it, but also be aware of those conditions that I just spoke about, both the condition of it being active and also that whether it's really an accident cover or is it like a cover which is like a once in 100 years kind of a situation, like meaning an accident cover, air accident cover. Yeah.
Okay, so next questions: people who had contracted COVID and were asymptomatic, would the insurer charge higher premium for them when they're buying a new policy?
If they were diagnosed with COVID, they won't be charged higher. Today, the trends are that insurers are looking at them slightly differently. Just 1 second, I need to.
Sure.
The insurers don't charge you higher premium mostly, but there could be additional conditions, like they could actually ask you for additional test. They could ask you to, if you have very recently had COVID, then they could ask you to come after, let's say, 3 to 6 months. They could postpone the cover. They could say that you would like to look at reports after 6 months. So there would be differential treatment even if you're asymptomatic. That's the answer.
Okay.
Yeah.
Great. So Mahavir, for for elderly people, what are the options available? I know it's difficult, but
Yeah.
any suggestions?
Yeah, so super tricky. I think if you try to look at policies for elderly people, is when you will realize that it can get very very difficult as soon as you have a disease or have any kind of, when you grow older, how it can become difficult for you to get a really good policy. So uh, the basic tips that we give to people who are looking at senior citizen policies, that go for a step down strategy. Look at the best policies available in the market and try those first. Most of the insurers, because of COVID, are not doing medical tests. They are typically doing video underwriting, which is calling on a video call and speaking to the person who's getting covered and understanding their medical records. Uh, so when I'm talking right now, I'm talking about someone who does not have any disease. Then those kind of people should first look at the best policies that are available in the market. Most of the policies, good policies, don't have an entry age limit. So the policy that's available to you is also available to them. So those are the policies that you could first try. Second, if there are diseases and if there are medical conditions in the past, or if there have been hospitalizations or some serious illness in the past, then in that case you would have to look at lesser, uh, uh, meaning you could call them lesser grade policies, which have much lower benefits available than that what are available in the best policies in the market, which is quite natural, because there is an issue with the kind of quality of health that is getting covered. So insurers are also worried. So they will put additional conditions or hike the premium for such kind of people. So people who have diseases, they have two choices. There are multiple policies. There are like 3 or 4 options available in the market, which offer you policies without medical tests, and you can get them quickly. And even if you have a medical history, but there could be conditions which are related to you bearing a certain share of the claim whenever there is a claim. Like it's called copay. You will have to bear, let's say, 20% of the claim or 25% of the claim from your pocket. This is to keep the cost very reasonable for people to be able to pay sustainably over multiple number of years. So look at those policies. That could be the second option. And the third is that even if both of these are not available, then you could go to looking at PSU banks and options available with PSU banks, where they have done tie-ups with insurance companies and offering group health insurance policies to their customers. So let's say you have a bank account with a government insurance company, with a government bank. Then that bank may have a tie-up with a government insurance company or a private insurance company, and there the conditions or the underwriting, as it is called, or the risk evaluation, is slightly liberal, and there are chances that you could get a policy there if you don't get in the first two options that I mentioned. So step down is the suggestion. First, look at the best policies. Second is look at policies which are with copay, which are some of the policies. If you go on our website and search for senior citizen, you will be able to see all these policies. Third is, if none of these two are working out for you, then look at buying a policy through a bank. Most of the banks have a group health insurance tie-up with a government insurance company or a private insurance company, and things could be slightly liberal. You may get through there if you can't get through in the first two options.
Great, that's helpful. There's one question relating to where can we see the term life rating. So what Mahavir mentioned, so it's there in the Beshak website, beshak.org. You can see the term life ratings there, and as Mahavir mentioned, the health insurance reviews will also be available mid-July onwards.
Right.
We have overshot our time, but we'll take one final question, which is from Rishabh Demlani. So, and he asks, is it true that insurance company cannot deny life insurance claim after 3 years of buying the insurance?
Yes, that is true. It's by law that insurers, even for cases where they can prove a fraud, won't be able to deny, only in case of death claims and only in case of life insurance policies. They cannot deny claims after completion of 3 years. So insurers have a 3-year moratorium where they can, if they want to do any kind of investigation, find out if there is any kind of fraud, or if there are claims in the first 3 years, then insurers can do all kinds of investigations. But once you have crossed 3 years, then insurers do not have any recourse to any kind of investigation, they have to pay claims. And so that's true. It's under section 45 of the Insurance Act.
Great. Perfect. So I see there are more questions. Of course, we will not be able to cover all, but I can assure the attendees that a lot of the questions here, at least relating to the term life and life insurance part, are covered brilliantly in the ebook by Beshak. It's available on their website, freely available for you. Please download that. It'll actually cover a lot of questions relating to term life that I see here.
And we also have sorry, I'm cutting you, but we also have a community forum on the website. It's free for everybody. You can come and ask your questions, and we have curated experts who can answer your questions. These are mostly founders of financial planning firms or people who have 10 plus years of experience in insurance advisory. So these kind of people answer your questions. It could be as elaborate your question could be. You could make it as elaborate as you want, and people will take their time out, experts, and answer your questions. You could just click on the community tab on the top right of the website.
Perfect. And if the audience is wondering, yes, Mahavir also sometimes comes and answers a lot of questions there. So you can catch him in the community as well. So thanks a lot, Mahavir. I cannot thank you enough for taking out time for this. I'm sure a lot of the attendees, would have benefited from this discussion. The video will be uploaded, it will be available more freely for others to benefit as well. Really appreciate you taking out time for this. Thanks to the audience for participating in today's webinar. I hope you found it useful. Keep safe and get insured.
Thank you, Ravi, for having me. Bye-bye.